Okay, so the next step to finding a profitable trade is knowing where to enter the market. Now, in the last video, we talked about directional bias, which way you should be looking to trade. That's defining what some would call the trend, the overall flow of momentum. So we talked about that using the 4-hour, and we're going to zoom in on this section right here, because these are really the markets that we really like to trade right here, is where we have these nice short-term swings in the FX market. So I'm going to zoom in on this 4-hour chart right here, and I'm going to show you how you would have navigated entries into this, because you can see that there was days where it just, all you had to do was know how to buy the market. And then this was a sell. Of course, this was against the white line, so you would have left this alone, being conservative. But this upside right here for sure would have been tradable. So where would you have entered the market? You see the 4 hours going up. You see that you're in criteria. You got blue above the last white expansion, so you know you're in a buyer's market. So you come over here, and now you're looking at this. Where do I get in? Okay, so the best entries, the highest probability and lowest risk entries to enter into the directional bias are going to be to do the opposite, kind of somewhat, of what the directional bias is. So if your directional bias is long and you're above the white line, that tells you that all the best entries are going to actually be the opposite of that. They're going to be below your last white line. Every time you get below a white line, price is going to whip right back up through and put you into the money. Until this trend ends, this is an important thing. It's a very simple concept I want you to get. Until if you're above the white line on this 4-hour chart and you got blue going up, until these candles turn and confirm yellow, meaning they close out yellow, this trend is going to keep going. And that means that every time you get below a white line right here, it's going to come around and pay you. Every time. Right here's another trade. Here's another trade. This was a big one. And conservatively, all you're trying to really do, to especially getting started, is you're just trying to get your entry below the last white line, and you're trying to take it up through the white line and cover with some sort of profit. Now, that takes finesse. Learning how to feel the market. It takes screen time. It takes years to learn how to get better at letting those profits run. So in the beginning, when you're practicing, you're just trying to get familiar with the software. Be conservative. Just try to take it below and try to get it up through, and then manage your profits when you get above. And this is, we're talking about, of course, a long trending market, meaning markets going up. So you want to buy the market when you're below that last white line. Wait for that whip to come up through, see what happens. If it doesn't want to push, if it seems like it's dying out, close it, take that profit. Right here you can see actually had a few entries, and these aren't small trades. This is a pound Aussie right here. For instance, this one right here, I mean, there was a reasonable 30 pips in that trade, or 348 points or whatever it said. If you caught this one here at the turn, just to get up through the white line, you got this is another 30 pip trade. So these are significant moves. This is a 15-minute chart. You can use this if you're trading in a daily setting, like you're getting up and trading the New York and London session overlap, or maybe the London session. These are great opportunities to scalp the market and get your 10, 15, 20, 30 pip trades. And some of them naturally turn into monsters. And the reason why is because you're trading in line with the momentum. The big money in the market is what creates this momentum on the large time frame. The people that make the most money, the banks, the big banks that control the FX, the hedge funds, all the big market players, they're not going to mess around on a little 1 or 2 minute trade. I mean, unless they're a high frequency trader or something. But for the most part, the people that really make the big trades are looking at these much bigger swings in the market, and that's what they are. The trades that they're looking to trade. They have to worry about liquidity to get in, liquidity to get out, when you're moving that much money as they do. So you're trading along with their strategy when you enter and exit the market. The reason why this works, because these white lines, which is one of the key components to this software is the belief tilting line. This is where your retail traders are going to chase the market around. When you get below these lines are programmed to read these specific price points where traders, once it gets below, your average retail trader is going to try to sell the market. Just because they're chasing price around. They're not looking at the big picture that's going on over here. So they're going to go, oh, the market's going down. They're going to sell it, and then institutions are going to come in and they're going to take the other side of that trade. They're going to say, okay, retail trader, you want to sell that? I'll buy that from you. And they're going to use that to fill their book of positions. And that's going to bring them right back up through the white line, and they may accumulate a lot of positions in a certain price range. But point is, institutions, the big banks, know that the flow of money is going up. And every time on the short-term time frame that you feel like, oh, this is the turn, is just another opportunity for them to come in, take the other side of your trade. You lose money, they make money. So that's why you have to align your thought process, your beliefs in that same way. And you want to take these trades, you want to milk these trends for all they're worth. One thing that I talked about I think in the directional bias video, but the earlier you start trading these moves, like you want to start getting your trades, on these first couple of candles when you got the new white line, because that's when your probability is the highest that you're going to get some sort of meat out of the trade. You don't want to watch these things go several candles and then, you watch 5-10 good entries go by and you can't take it anymore and you jump in here at the top. You don't want to do that. You want to start trading early. You want to time the market. Okay? So, and that leads me to, I've kind of bled into that concept, but that's my next thing, is that you want to be aggressive at the beginning of these moves. Right when you get in and you get confirmed in a directional bias, that's where you want to get aggressive and find some meat out of that trade. And then as the market goes and goes and goes, you want to scale out of your aggressive your aggressiveness to try to find those entries, because eventually every trend will stop, and you want to try to avoid getting caught in the turn. Your money, the money you're going to make, is going to be milked out of the middle of these moves. You had the move right here, you had a move right here. That's where you're looking to get. We're not trying to predict the market. We're not guessing the turn. We are taking momentum that's already established, that has a high probability of continuing, providing you get in early enough. You start looking at that and diagnosing that market correctly. We're looking to get in on that move that's already happening, and then we're looking to find our entry on that lower time frame and just get a little bit out of the center. That's it. Real simple concept. Like I said, it will take some time to learn the finesse of entry. But this is a basic thing that if you can get down sooner than later, it's going to help you dramatically. Another thing I want to talk about, because it's all about the way the big banks trade, is that they need liquidity to get in and out of their positions. Okay, they're not trading dollar per pip positions. Okay, they're trading huge position sizes. So in the market, if you're new to the market, there's something called slippage. When you are trading such a big position, then you may want to get out of that trade, but the broker, the market maker, has to find someone to match that trade with to get you out of the market. So when you're trading these huge positions, you may say, yeah, I want to get out now, but that trade may fill way later depending on the position size. So that's how the market makers are trading these trends and getting into trades and scaling out of trades, is because they are finding liquidity based on what the average retail trader is doing, because that's why retail traders all pretty much lose money, is because they don't understand that that's how the institutions trade. They use their liquidity, their beliefs about future price to enter the trade and exit the trade. So another thing I want to talk about is the liquidity lines. You have the green lines and the red lines. These can be used for entry as well. You can see right here, you could have entered on this candle right here. We were only buying the market at this time because it was right here in this 4-hour section here. So you could have bought it, and you don't need a liquidity line, but right here you see you dip down below. You're below the white line. You know you're trying to buy the market. You had some liquidity right here. That liquidity line represents retail traders selling. if you see, we had a box right here, price boosted out of that box. A lot of retail traders bought that right there. They see, oh, price is going, this is it. And then you see all of a sudden, you know, they're jumping in, buy, and then they're taking out the money. And now they're sitting like, okay, I think the trend's going to take off. Well, this represents their stop loss level. That's the way these liquidity lines work, okay? So right here, if you look at how this all played out in this section right here, you have retail traders buying the market, and you know that if they bought anywhere up this candle, if price got down below there, right here, they're going to be out of the money, and they're going to start to feel really uncomfortable about that trading position. That's what generates that liquidity line right here. So you can see if that retail trader bought, then they see the market's going against them. That shows them a little love right here, shows them a little love right here, and then bam, whips them out and gets down below. They couldn't have possibly entered that move below this point because it started right here. So all it took was market makers to drive that market down, pick up that liquidity, because what's going to be down there is their stop losses. If they bought, this is a sell stop right here, okay? When they trigger that sell stop, what's the other side of a sell order? It's a buy order. So that allows the market makers to get in, suck up that buy liquidity, fill more of their book with good positions at a discounted rate, and then boom, that's the minute the market takes off. So it's just this game of manipulating beliefs of retail traders in order to get the best price in a rising or falling market. And that's what I want you to do. It's the same thing. You want to align yourself with the big banks. Remember, they're moving the market on the larger time frames. The 4-hour, the daily, the weekly, the monthly. That's where the big money is. All the rest of this noise is just ways for them to get discounted prices that are excellent trading positions into that existing trend. So one other thing is that you can enter on retracements. A retracement in our methodology would be defined as you're already above the white line, but you can see that the market is taking off. But you see that you had a pullback right here, and then you can buy that blue candle and see if you can get another little push. But these trades are a little more risky. Okay, remember, the farther you get away from that last expansion, then the more risk there is of the move dying out. So in those cases, you need to be a little more careful with monitoring your risk and a little more conservative, because remember, the further that trend goes, it eventually will stop. So anyway, that being said, hopefully that kind of clears that up. Let me, while we're at it, I'm going to show you, we'll go over a few sell entries here. You can see the same thing right here. This was this section of the market here. We were only trading short at this time. You have confirmed yellow, meaning the 4-hour close in a yellow candle. You can see you're below the last expansion. So this is all selling opportunity. And here's your trades right here. You're above, you got a white line right here, white expansion, boom, there's a trade right there. Here's another one, trade. This one got through, but I don't know if you would have taken much profit off that, but you did see it peaked through. You probably would have got out at maybe a break even on this one, but you're still above, so you could have sold back up here once you broke this high. This was all tradable. Boom, there's your next trade. Here's more in here. Just these whips, you would have been trading all these short. You stay short with that short directional bias. And I'm telling you, don't see the mirage where you think, oh, this is the turn, I'm going to catch it at the bottom. Stay with that trend, stay with that directional bias, and you will see profits on all these, even these little trades that don't end up paying much. You can still take small profits off those because you're married to that directional bias. You're trading with the market makers. You're trading with the smart money, and that's going to give you the best trading positions with the lowest risk. So hopefully this clears this up, and start implementing this and start practicing with it, and you'll start to see the light here. So anyway, we'll see you on the next video.